All right, welcome everyone to the Futures Workshop. We're going to be going through part 4 today. I think this is where a lot of people are going to get more excited, I guess, right? I think from yesterday you guys were pretty excited, but I think today this is the part that everyone's been waiting for. So we're going to be talking about the introduction to order flow and reading the DOM, the depth of market, a tool that has a lot of importance in the market. It's not the easiest tool to read. It does evade a lot of people's understanding, and it can take a lot of time actually to learn exactly what you're reading, what you're looking at, and so on and so forth. So if you do guys have questions, please drop them in the Q&A. I'll go through them at the end. If you have something important that you do want me to see, put it in the Q&A, please, because the chat can get overwhelming. And especially as I'm going through this, I'm not necessarily going to see everything, not because I don't want to, but just because there's going to be a lot realistically. So the Futures Workshop layout, right? We did a 5-day consecutive day-by-day introduction to a lot of different materials. And we're coming into day 4 right now, the introduction to order flow and reading the DOM. This is the second to last, actually. And tomorrow we're going to wrap this all up. So the goal, it's going to be to navigate any market condition in the futures market using futures equities. I predominantly just trade equities regardless of the asset, right? Futures equities, the S&P 500 is the most liquid equity, and it's the best, especially for beginners, to start learning if you want to learn the order flow, because it's a more tame environment. Tame said loosely in comparison to other futures markets. So I want to go through this and break these things down. I want to make sure that we understand how to trade any market condition, regardless of the volatility, the volume, and the opportunity in the market, even though you might have doubts. So throughout this workshop, I've been promising, but I want to show you 3 very, very simple tools that you can apply to the futures market, regardless of the market condition. And as you know by now, they're all based on volume. So we want to create a step-by-step system to create self-confidence in how we trade. Regardless of how fast or slow the market moves, there is going to be opportunity no matter what, right? And the main aspect to this is understanding that these areas come from patience, right? We trade areas that we're interested in, not just any area. So in today's agenda, let's break this down. Something that everyone's been waiting for realistically is the introduction to the order flow and the ladder. We're going to be talking about how the DOM actually works, right? What are the key aspects of the DOM? How to look at the DOM from a very specific and reactive way, right? Because we can't anticipate in this market. We have to read what's going on. And then we're going to be talking about some examples, right? We're going to be breaking down a replay, and I'm going to be showing you guys it's going to be fast. I'm going to be showing you guys the speed at which DOMs move and how I like to analyze them, talking about reactivity, giving commentary, as I did throughout the morning room, right? So I'm going to be telling you guys what a bullish and bearish DOM looks like, how to navigate specific directionality, and how to navigate areas and how they test. So we're going to break this down. We're going to wrap it up and then talk about what we have coming up next. And that's tomorrow, the final day. More of a wrap up, talking to you guys about how you can actually elevate your trading or develop as traders as is and create an edge for yourselves, deep dive into building your account up, yourself up, and finding a potential career in this. So let's talk about this. Let's dive right into the order flow aspect. We're going to be talking about the depth of market today. And a lot of people, especially when trading futures, right? Some things may work, some things may not work. Some things you find that work, but you have to take on more risk. Sometimes they don't work consistently, right? When market conditions change, you might get confused as the markets move differently, but there is a missing piece in all this. And I think that this missing piece allows traders to consistently trade the same way, regardless of time of year, time of day, market conditions, seasonality, all that stuff. So what's the missing piece here? Order flow is reading how large orders enter the market and move the market, right? Because when we think about volume is what moves price. If you have 1,000 lot buyer, right, realistically, the expectations are for price to go up because someone wants to buy a large quantity, right? That means a big buyer like that does have expectations of continuation to the upside. So realistically, when you see volume like that, your expected move is to the way up. Now you start building confidence as more buyers enter the market consistently, right? So let's say someone wants to buy at 4,000, a couple of hundred lots, right? Okay, that's great. But that doesn't necessarily give us too much information. What gives us more understanding and information of where this market could be headed is let's say another couple of hundred lots buy a few ticks higher, continuously, and continuously. And this is what creates a bullish DOM, a bullish market, and an upward trend. So if you start to see more buyers actually entering and moving prices, that's what's going to continue the upward trend. So that's what we're trying to decide. And this is what we're trying to discern from the DOM. This is what we're trying to understand from the DOM. Where are buyers and sellers actually coming into the market with aggression? So if we can see how big money is interacting with itself, right? Meaning that you're going to have big buyers and big sellers. Big money isn't always right, because there's so much big money out there. Big money has to trade with other money. So when we see how they interact with one another, we can identify the direction of the move, the entries for a potential move, hidden stops, right? And confirmation of trades actually working. So when we talk about order flow in the ladder, right, we keep preaching about order flow. You might have seen this for years now. It hasn't changed. It's been a directive for a very, very long time, right? We have talked about the footprint a lot, which is not something that I do want to cover, because I'm a firm believer of learning the basics before you can learn something more advanced. And the depth of market is the first place to start when we talk about order flow. So we've not really done too much of a deep dive into the DOM with everyone, right? Especially people that are outside of TPA, but this is what we're going to be focusing on, right? Order flow is watching the flow of the market, orders moving the market, and orders stacking up in general. It's the volume that moves the market. Market orders that flow into the market, flow out of the market, give us an understanding of the directionality of the market and the expected moves. So order flow can come in many different forms, but the base case, the basis, the ground level of order flow is going to be the depth of market, because that is the originator of what we would consider order flow. Others can be delta, footprints, heat maps, right? All derivations of order flow. So the depth of market introduction. This is a DOM that I've made available in Discord. You guys can go and fish that out. This is a darker themed DOM. It's got a lot of different cool things on it. So the depth of market, or the DOM, is the epicenter of all order flow. Here we can see how all the orders flow in and out of the market realistically. So on our DOM, we have 6 layers, right? I'm going to talk you through these 6 layers, and we can start breaking them down individually before we group them together to get a better understanding of what it is exactly we're looking at. So you can download it on our website, you can download it on Discord, whatever the case. Number 1, right, is going to be the volume profile. You can see the volume profile. This is the most obvious piece of this depth of market. Number 2 here that we've marked is the price, right? This is the most maybe meaningless point of the DOM. Just we should know where price is actually sitting, but it doesn't really affect anything. Number 3 is delta, right? Delta. We're going to be going through all of these individual 6 layers by themselves. I'm just showing them to you right now. Number 4 is the bid and the ask column, right? So you got blue bids, red ask or red offer, right? When you click on the DOM under price on the bid side, you're putting limits to buy. If you click above, you're actually getting in at market. Same thing here on the red side, on the ask side. If you're clicking areas above the current price, which is in yellow, you're putting in limits to short, right? To open up a short. If you're clicking below, you're entering into a market short. And then number 5 is going to be our last traded bid and ask, right? So this is the size that comes in at once, right? So these are market orders. And then number 6 is going to be the cumulative bid and ask traded. So if you take the volume profile, if you divide it between bid and ask, that's what you're going to get here at the number 6 area. And this is important because you can see which buyers and which sellers are coming in at certain levels, right? Who has more control, so on and so forth. Now, number 3, which is delta, is just the difference between number 6. So let's talk about these in more depth here. The volume profile on the DOM has a similar purpose to a general volume profile, right? We would mainly use it in the later portion of the session, right, to allow the volume profile to kind of shape up. So this volume profile itself, the one on this DOM, it includes the overnight session, so you can use it earlier in the morning session, but you would want to see a little more data flush out of the market to start using this a little more effectively. We use the volume profile on the depth of market as we would on any normal volume profile, right? We found our ledges, we found our distributions, and we can trade based off that. So it's a very good tool that's very close to where the price is currently sitting. So you can see where price is in relation to these nodes, to these low volume areas, to these distributions. So it's a bit easier to discern. It can help us with entries, exits, trailing especially, and so on. So the volume profile here, it's very useful, especially after the initial balance of the current session, which happens to be the first hour of the day. You can use the ledges on the volume profile as you would in distributions, right? For trade entries, volume profile ledge is an extreme that we would like to play off. So it works very well that the DOM can visualize this volume profile in this area. So the premise is we can see it on the DOM where it's easier to visualize rather than maybe looking at a chart and trying to discern what the exact level on the chart is, where the distribution is, what those areas are. Right here, you have it right beside price. So you can get a fairly solid estimate of where we're trading based on a volume profile. Are we trading when balance, outside of balance, into ledges, right? So on and so forth. So when we talk about the DOM market price and the bid and ask limits, they're not necessarily as important as you think. I know that there has been a lot of emphasis put on bid and ask limits. Those are just resting orders realistically. They don't necessarily have the ability to move the market as they once did a very long time ago. Price tells you where we're trading. It's a fairly arbitrary number, right? But it's always good to know. The bid and ask areas are where we place our limits, and you can see how many limits are present in those areas. So a lot of people look at large limits on the DOM and they think that these are price movers. They can slightly influence price, but if they don't trade in that area, they're not that important, right? So unless we're almost at that limit. So for example, this might be a little confusing, but when you look at the limit side on the bid and the offer, and you have larger orders, right? A lot of people might be thinking, oh, those are liquidity magnets, right? Well, they don't trade at market, so they don't have a direct influence on how the market price moves. Remember, when you see market price movement, that movement is based on market order trades that are coming in, right? If there are more buyers than sellers, right, the price is theoretically going to go up. When you have big limits resting on the DOM, those are just resting orders. And if you get closer to them, they might have some influence on how price trades. But ultimately, if you're close to maybe like a 500-600 bid, right, I would want to see if and how that bid trades to get a better understanding of if this is going to be a stuck short or it's going to be just a burst to the downside, for example. So they're not very influential until they're traded or until they're extremely close to those prices, which is not necessarily what a lot of people would think. The last bid and ask traded, right? This is the last quantity traded, those two middle columns, and these are the market orders. How many buyers and sellers enter at market? This is the most important piece of information on the DOM because this is where we discern market buyers coming in and their reactivity with one another, propelling prices forward. So if we're hitting the bid, right, we're going market sell. And if we're lifting offers, we're going market buy because we're taking those orders off of the book. Right, you're going to see all kinds of orders here. We want to see how they interact with levels, each other, and the speed at which they move the market. So I'm going to expand this in a bit, but the main premise that we have to know about market orders that come in at number 5, right? I was just talking about number 5, where the big market orders are coming in. This is something that we're going to do a replay on today, but the main purpose here is twofold. You want to see the way they react, meaning upticks or downticks, and the speed at which those reactions happen, right? That's going to give you understanding that one side or the other is actually strong. So the last bid and ask traded, right? They have numbers that flash from 1 to however many. There's no maximum. I honestly haven't seen more than like 5,000 coming in at market. And this isn't one big order. It's the accumulation of those orders based on like a 2,500 millisecond interval. So it's watching these large orders come in, not necessarily being one big player, but multiple trades hammering in at that area. So watching large numbers print is important. However, It's how each of these orders interacts with one another. The move from that order and the speed, right? This is a very, very important factor here. For example, if we're at a resistance and on the DOM here, right? This one I'll draw out for you. This red side beside the bids is market sell. This blue side beside the offers is market buy. If 400 go market sell somewhere here on the red side, right? And 300 at that same area go market buy, right? What happens? So you obviously know that 400 is bigger than 300, right? That's a well-known fact, I hope. So 400 sellers coming in and 300 buyers, you're thinking, okay, well, 400 just came in on sell, so the price must go down, right? But that's not necessarily the case because there's many orders that trade in that area. There could be orders that trade slightly above and slightly below that influence that as well. So you want to watch how these guys react, right? When we start seeing larger orders, we want to see the reactivity. If we get an uptick, meaning that prices jolt up after these 300 buyers come in, those sellers are accumulating in a stuck position, right? Even though they're a larger number, they're not necessarily holding out the sell side and the buyers can be taking control. Especially when you see very, very big sell orders coming in and they're getting upticked on buyers, right? Not necessarily bigger buyers. That suggests that you're seeing weak-handed shorts entering the market and strong-handed longs that are about to open up more long size and burst through the upside. So what happens on the downtick in this scenario? Right, same scenario, but this time we downtick. This is the expected move where the sellers are actually holding their ground. When we talk about the cumulative bid and ask, this is the second most important level on DOM. This is number 6 over here, right? This allows us to see the total contracts traded at the bid or the ask at a certain level. And this can show us where there are overwhelming sellers and buyers. Are they stuck? Are they holding price? How is price reacting to these orders? Because once you start seeing discrepancies in these, because they don't have to be completed full equal areas, right? You can have 1,000 lot seller that comes in versus 500 net buyers, right? So you have to ask yourself, where is price in relation to these large orders? So we do want to clear these every once in a while, obviously. So at the start of a session, I want to clear these because by the midpoint of the session, you have these massive numbers that don't really allow you to see what the discrepancies between the buyers and sellers are for that session. And then finally, we have delta. Delta is the difference between the cumulative bid and the ask at a specific level. You can have very big positive or very big negative deltas. You can see here on this ladder, we have a very large negative delta, and we have a few of them stacked up in this position, right? We have large negative deltas, a very, very thick negative delta, and you can see prices below some of them, right? And above some of them. So what does this mean? Negative delta is supply side holding control, quote unquote control. I say this loosely because it's all about market reactivity in the market, and we discern the information that we get from the market, because you can't just say, oh my God, there's so much negative, there's so much sell side, there's so much supply, it has to go down. That's not necessarily what market reactivity is, because there could be strong-handed buyers that are actually sustaining price. Positive delta, the demand side's holding quote unquote control over that level. And again, this depends on reactivity and as well as quote unquote larger delta ledges. So a larger delta area, I would say, is over 1,000, maybe over 1,500. So let's take a look at what this means for us, right? You have 3 levels here that are net about 7,000, maybe a bit more negative delta, right? Prices under it. This was very close to a top. These are stronger handed sellers that are trying to push prices lower, right? Prices below that area, they've managed to do their job, and larger sellers are trying to attack and push this level, right? It would have been much more effective if they were a little higher, but that's rarely the case realistically to find them at the very tops. So remember, institutional size traders or like big lot traders, they might not have stops, right? Their stops might be based on daily closes. Their stops might be 20, 30 points. So it doesn't matter if they're shorting 89 or 95, right? 6 points difference doesn't really matter to them. That's why they choose areas of interest to them, and they throw size on. When you have larger negative deltas like here, negative 3,000, negative 2,000, we're sitting above those areas. Those are traders that actually got stuck short and price actually burst through with strong-handed buyers, right? So it all depends on reactivity. Now, large market orders, this is a huge topic, especially if we're talking about strong-handed sellers, buyers, and institutional money. What is a large market order, right? This is what actually would move the market. In the middle columns that we've just been talking about of the DOM, you're going to see market orders. These are going to move the market, and this is going to be based on how they react with one another, the speed at which they react. And it's not all orders, right? It's the large orders that grab our attention. We have to understand what average size on the book is. On the ES, in these middle columns, average size, it can be around like 100 to 200 on the ES, especially in these market conditions. So that means anything that's higher than about 150, 200, which would catch our eye. So it's been the case for a few years now that the average is something like this. So to consider a big order, right, we're looking at something in like 300, 400s and above. Market reactivity, right? These large orders, it's not that they just come in and you have your direction. It's how they interact with one another, right? When price trades through liquidity, you're going to see continued large market orders that will move the market in that direction, where we should see a rebid or a reoffer, right? The movement of the market in its most basic form on the DOM would be up or down. So if we have a move to the upside, we're going to see lifting offers on the DOM. So the middle columns, the blue side, is going to be lighting up with larger orders between 100 and 300 continuously as the market continues to go up. That doesn't necessarily mean that it's just going to continuously go up without any pullbacks. You can see minute pullbacks, but the pullbacks are generally, if it's a straw bull trend, going to be on weaker volume. I don't mean weaker size. I mean weaker volume, meaning they can have 300-400 sellers coming out, but the speed at which these sellers come out might not be as strong, right? They might not be as reactive. They might not downtick initially, or they just might be smaller size, right? So anything above 300, I would consider pretty substantial size. Real market activity. For this to continue, we would need to see the sellers on the red side hitting the bid, meaning coming out on either smaller numbers or getting disregarded if we're going to see the upside hold out, right? The market can move up or down a few ticks. As long as it gets rebid, it should continue the upside move. So again, there's a lot of replay and practice involved in understanding how this depth of market actually reacts. It's not all ones and zeros, basic black or white reactivity where you see large orders doing XYZ and that's how they should sustain. It's all about reactivity with orders and the speed with which the orders come in. So the basis for an up move is buyers, the basis for a down move is sellers, right? You can't continue up without big buying and you can't continue down without big selling. It can happen for a bit, but it's not going to be sustained. So if you get 100 to 300 contracts every few ticks and the market continues with a buy, with some sellers down ticking it, but getting pushed back up on more buyers, the move realistically should continue in that light, and a rejection won't happen unless the sellers disrupt this flow. Meaning that if a massive seller comes in and reoffers by a few points, and every time it tries to bounce back, it keeps getting reoffered aggressively, that's when the DOM starts to flip a little more bearish. So let's talk about DOM reactivity and how it works, since we've been talking so much about it, right? In practice, or in theory, I should say. In practice, right, the market will trade market orders, and we want to keep note of the larger market orders that enter the book. Again, it's not as simple as seeing 200 buy and just starting to buy with them. As we mentioned before, it's how they react, right? Two factors to consider: upticks or downticks based on the orders that came in. So if big orders come in on the buy side, are they actually upticking by a few ticks? Meaning, is the price going up by a few ticks? Or is the price not moving and downticking by a few ticks? That's not good for the buy side. The speed at which the market moves, right? The speed at which the market moves off of these upticks or downticks. If you get a couple of 100-lot buyers and it jolts up like 3 ticks very, very quickly, realistically, that's going to be a big buy side momentum shift. Now, these areas where to find these traders, because the DOM's going to trade multiple hundreds of contracts at pretty much every level. So to get out of a confusing mindset and a confusing view of the DOM, you want to implement the volume profile for your levels, meaning watching the volume profile areas as the DOM reacts and interacts at those areas, right? So only watch DOM reactivity when you get to those areas as a newer trader. Upticking on downticking based on market orders. Upticking or downticking on market orders means when the market trades buy side, so offer lifting, and the market cannot uptick, instead it downticks and cannot keep rebidding, the buy side is going to evaporate. So when there's a market sell that's at 300 contracts hitting the bid on the red side of the DOM, and we get a market buyer of 100, the market seller is higher, right? But it's how the two are going to interact with one another. If the market seller manages to downtick through the buyers, then we're mostly going to see some more sellers see this action come through and push to the downside. If in this case, the buyer holds out the sellers and this 100 lot buyer manages to uptick the sell side, you'd want to see more of his buyer friends start stepping in and upticking the market so they can push those 300 sellers away and run them over. The speed of the market, right? The speed at which the market moves based on the market orders presented is super important as well, right? Overall, if the speed is slow on any reaction, buyer or seller, you're not going to, it's a lower probability to see the continued move in that direction. The higher the speed of the reactions, with the larger the orders, the stronger the potential move and the stronger the directionality on the DOM is. Again, an example. If we have a market seller that comes in at 400 and the price drops super quickly and more sellers continuously sell, even if they uptick back into those sellers and they keep just slamming it, sell, and it downticks aggressively, that would push the price lower. You're expected to see a larger drop in the market. However, you flip this around and a big seller comes in, the 400 seller drops into the market and it pops back up. It drops another 400 seller, but it barely moves or it starts upticking, then this seller's in trouble. This leads into one of, I'd say, the easier patterns to understand on the depth of market and the most pivotal pattern to understand for large rejections and large moves against the trend and large stop hunts. So stuck traders are one of the best criteria for fades, right? They present stop runs in the market, which usually have 10 to 20 point potential moves, right? So what is a stuck trader? Stuck traders are traders that come into the market late, right? They're not necessarily retail traders, but they're traders that aren't necessarily in the large portion of the move, right? They come in late, they come in at highs or lows of that move, and their accumulation no longer continues the trend, right? It's an accumulation of large market participants at the tail end of a move, and these traders are the point of inflection in the market move, right? They're the inflection. They're what allows price to reverse and stop hunt. So these traders should be remembered, right? Meaning that you should understand areas where stop hunts happen for the future, right? Because those areas that have traded in the past, right, can still be either massive points of inflection or they're going to be massive points of prices following through. So let's take a look a little more into these stuck traders, right? Finding large reversals in the markets through stuck traders is pretty much buying massive drops or buying massive runs, which is helped by the volume profile. Remember when we talked about distribution theory yesterday and understanding where large inflection points were? The starts or ends of big distributions are large inflection points, which usually come into confluence with stuck traders coming in the market. Again, there's two ways to find large market reversals: a combination of using volume profiles and key inflection points and relying on the DOM to see where those traders are actually getting stuck and reversing its bias. So a stuck trader can result in a large move as their stops get ran, and these participants, meaning only weak-handed traders, are left, right? They're late participants. These are the weak-handed guys that are left in the market. Strong-handed traders have already taken advantage of the move, and they're taking advantage of them and starting to enter into a position for the reversal. So let's talk about stuck longs, right? What does this mean? A stuck long is going to appear at a current market top, right? It's going to appear at a current resistance point where the expectations for a turnaround in the market, right? This is the accumulation of market buyers lifting offers and absorbing of offers flushing. So this would technically mean a stuck long. You're looking at the blue side of the column and you're looking for large orders to consistently come in, right? Ideally, they're like 600, 700. The bigger, the better. Usually around 1,000, you start gaining confidence that these traders are getting stuck, right? If you have 1,000 market order that comes in buy and price cannot move up, instead it keeps down ticking, down ticking, down ticking, and they keep adding and adding and adding. The expectation is you need one big seller to say, okay, they're stuck, and that's going to be a reversal. Not make their break to the upside. Instead, there are downticks, and overall buying becomes static or very, very weak. We're going to explain this in just a bit. So stuck shorts, quite the opposite of this move. It's sellers that are getting accumulated and absorbed at the bottom, right? Meaning that there's large orders that are coming in on the red side here at these lows at an expected low, and they either uptick, stay stagnant, right? And maybe more bids are getting thrown at them, which causes this number to largely increase. There can be a flush to the downside by a few ticks, even where the stuck trader is. The stuck trader doesn't indicate that this is the exact low tick. There can be a few tick flush and then a rebid to accumulate those strong-handed buyers to actually reverse this, right? So these are very, very important things to watch to see if there's going to be market inflection points, right? You want to watch to see if they flush or if they continuously react. Typically, if you get the accumulation, the absorption of traders at a top or a bottom, the flush and the continuation is fairly low probability. So you always have to remember that just seeing the accumulation of stuck traders is not going to be enough, right? Just because a trader is stuck, that doesn't necessarily mean that you're going to get this massive, massive reversal and a stop's going to get ran. You can downtick by a few ticks or uptick by a few ticks until you get that reversal, because stuck traders get their stops ran when there's market buyers or sellers that oppose the current position. To get a move to the upside, you need buyers. To get a move to the downside, you need sellers. So you have to remember this even when stuck traders are coming into the market. So if you're at a stuck short and there's massive absorption on the sell side, you need a market buyer to step into the market, right? You need a market buyer to step into the market and reverse that position. Without a strong market buyer, the move might happen, but it's not going to be very long, right? So when we have stuck traders accumulated, you need to see the reactive buyers or sellers. Suppose we at a low, we have 1,500 bid hitters, right? We got massive on this red column. Let's say there's 1,500 at this area. So they're absorbing. There isn't anything stopping them from dropping, even if it's a head fake, right? So you need to see a rebid, maybe a couple of hundred, 3, 4, 5, 600 come in and uptick it by a decent bit to see that potential reversal. So the requirements are an uptick and speed on which the uptick happens. So what we're going to be doing is going into Sierra charts. We're going to be talking about how DOM reactivity works. I've loaded up a replay from Friday. If you guys were in the futures room with me, you guys heard me talking about this and the shift from the bearish to bullish DOM and how we were looking to sustain that buy side. So I want to go through a few little examples here and show you exactly what it is on the DOM. So this is going to be a little replay feature. Let's hop into it and see what we're looking at. So before we jump into this, this is the main screen that I use, and this is a replay of Friday's session. So Friday, remember our trading plan was let's get long somehow, right? That was the idea. I wanted to get long into these like lower 30s, maybe mid 20s at some point. And the reasoning for that was you had a few key areas. Sorry, it's not sharing. Can you see it now? So we had a few key areas to the downside that I wanted to see get pulled back into because we opened above a key distribution, meaning that the expected direction was going to be to the upside, right? We had a nice little bid into the opening session, into the end of last session. So my thought process was, let's see if the bid can continue because we're outside of all these distributions, and I would like to see a pullback to get new buyers into the market. So as price was dropping off of this key resistance point here, we got to move back down into 50, 51, 52. And this is what we're going to read. These middle columns in this DOM right now, which are going to be of most importance to us to understand when we get a flip on the buy side, right? When the sellers kind of die out, I don't think there's a stuck short necessarily, but you're going to see a very swift reaction in the market. And we're going to watch how we rebid above the 60, which is a key area, and how this bid progresses from 50 to 60 and through, and how 60 area holds multiple bids to see the next leg even higher. So we're watching this as it comes down. You can see there are larger sellers coming in. You have a 600 seller, right? You have a 300 buyer. You see the 600 seller at 53. He's having trouble, right? He's not necessarily down ticking aggressively. So here's the move into the 50s. 300 go by, right about here somewhere. Watch this. So let these numbers load and I'll explain them. So you get 600, there you go. Okay, right here. This is what happens. You get multiple big sellers coming in from 600. Here he kind of struggled. When you see a massive order like this in the 600, 700s, you expect like a flush like that, right? He struggled, kind of danced around. You get this drop down. 500 goes sell, 650 goes sell, right? 600 goes sell, 375 goes sell, and they start struggling at this low. The second someone throws in nearly 1100 buy side, you get a swift uptick by a few ticks, right? And now, as a buyer, you're trying to limit into these areas to get long, and or you're trying to see if there are much bigger buyers that rebid this price, meaning 300-400s and whatnot. So these sellers flushed aggressively. You saw the speed at which the sellers came in, right? It was quick. Multiple 500 lot sellers came in and they started accumulating at this low. And once the 600 seller came in at 49.75, he stalled out a bit. He stalled out and some strong-handed buyers said, perfect, this is the top of a distribution. Let me throw massive size on this and uptick this price. And watch as bids start coming in. There's a 232 bid that upticks with another 350 bid, a 200 above that, and you're seeing the speed at which these buyers are pressing price. Another 478 bid comes in, just uptick. So right now, like, this is it. Like, you could be even getting into this position late and understand that your stops have to be below the low. You're seeing what is a decidedly bullish DOM with weak sell side coming in on the offer end, right? This is what a shift in directionality on a depth of market with a strong bid looks like. So watch as we enter into the 60 now. See, even you get a downtick and they just say, you know what, that's fine. We're just going to buy more. You throw in 100 lots, right? These sellers are coming in now 300, 240, 356. Right? They're not really shocking price. Another 200 upticks with a 200 buyer. So in that area, 1,000 lots at 4 levels gets upticked by 300 buyers. Again, 300 fighting another 400 seller here. A little downward move. 260 trying to buy, 280 trying to sell, 316 upticks again. So these are the original buyers down here. And right now, even if there are some sellers that are trying to pull back, every time you downtick by a few ticks, you get a nice reactive bid that comes in that flushes whatever sellers are through this market. 700 goes market sell, gets upticked by a 600 and a 500 buyer. This DOM is bullish. Every time big sellers come in, large market buyers step into price. And you'll notice that the sellers, they don't move it down more than like 4 ticks realistically on this. So this is a very, very bullish DOM. 500 goes market buy against a 500 seller, upticking again on another 400 buy. 300 seller, 400 seller, pulling prices lower. A 200 seller again, right? Little pullback here. Large sell orders coming in, buyers still holding their ground. And this is where you can start using these delta prints, right? Negative 900 delta, those areas should hold. Big negative delta areas should hold. 400 buy side, 500 buy side here. A little reactive. It's found a little resistance here. 320 buyers coming in, 400 buyers, another 300 buyers above that, upticking 600 buyers at 2 levels. Some sellers are trying to push this price, but you can see the reactivity on the buy side is a stronger push and a faster push. I wouldn't be too excited even with these sellers coming in, because you might see this and think, okay, well, I just saw like thousands of sellers coming in at 57, 58. But what's the lowest point of this move, right? Like 56 or so, around 56. So you're telling me a couple of thousand sellers only managed to move price down by a point or two? That's not, it's not a bearish move, right? Regardless of this pullback and the size that they're putting on. If this just started to aggressively drop, okay, you know, maybe the long's not that strong, but watch as every time you get a 1, 2, 3 point dip, buyers say, oh, nice, a better price for me to get in. Another couple of hundred rebid there. 250 on the bid, 230 on the bid, 300 on the bid fighting a seller, a 300, 400 seller, 500 on the bid going uptick in the face of a 440 seller, uptick again. This is it. That's the move. Every time the sellers come in, the push isn't that far, right? And we're about to enter above the 60 area, which is another start of a distribution that can take us towards that 4,300. So every time these big sellers come in, you get a nice little rebid and they just push them aside. So 400 sellers coming in at 60. This is an area where they should fight. Nope. You get a rebid on a 600 seller coming in. 700 seller gets rebid right now and upticked. They're losing ground, right? This isn't it. And you can see negative 1,000 delta at this 60, right exactly where you'd expect to see some sellers coming in. 350 sellers struggling. You can see it downticks a bit, gets rebid. Sellers are still coming through here. Nothing impressive though. They're just getting jammed into these highs. 220 seller comes in, gets upticked by a 200 buyer. So whatever sellers come through, they're just getting used as liquidity realistically. 468 buyer comes in, upticks. There's somewhat of a reactive sell, but the offer isn't on big size, right? You have 50s and 30s coming in. Again, like the sell side, right now, the sell side here at this 57 is pretty thick. You have 600s, 500s coming in, 700 sell coming in 57. They have to dump this here. 800 sell coming in, 900 sell gets rebid on an uptick sweep by a few ticks. It's not bearish. Like this isn't an area to sell. If you get an 800 seller coming in like that, like they just dump it. The reactivity on that sell wave to start it was weak, right? It was on weak volume. The bigger sellers came in at a lower level and they're getting upticked right now on some buyers. Like I don't necessarily think that this is a reversal point. 265 sellers just got swept away. And there's the rebid. You want to rebid it a little more to convincingly say you're above the 60 distribution start. And see, you're still getting some reactive sellers coming in here. They're just getting swept away by big buyers, right? So this is by definition what a bullish DOM would look like. So this is the main thing that I did want to talk about in terms of the replay here today, right? Give you an understanding and give you some eyes on what this DOM looks like and how these things shape up, what a bullish DOM looks like, what reactivity looks like, and how to find or how to locate some fake sellers realistically. And I do these replays. This is a part of the replay library that I was talking about yesterday, right? Our DOM replay library, especially when days like this happen, I'll do a replay or review some of the trades and talk through the DOM as to why these things happen and things that you should be looking for. So I hope you guys enjoyed this part of the presentation, right? A lot of you guys have been asking for the DOM and what it looks like. So that is the basis of our DOM, right? How it shapes up, what I'm looking exactly at. And I do want to continue with this, right? So let me know, of course, if you do have any DOM questions. I'll look at those at the end of this presentation, but I do want to thank you guys again for your attention today. Today we covered a lot, right? We finally covered market depth and order flow. And it's not necessarily an easy tool, right? Even if you watch me talk about that and read it and look at the DOM live, it's not necessarily a tool that you can grasp at the first go. It took me about 5 months to understand this DOM to the level that I do now, right? Of constant replay, constant reviewing, reviewing trades, reviewing inflection points, replay, constantly, hours of it to understand what it is I should be looking for and what the reactivity of the market really looks like, right? About 5 months to get comfortable with it. However, now I trade with the most confidence I've ever had in the markets, and you can too if you do put in the time and effort to read this DOM, right? I can't make you a DOM expert because the work is pretty much on you. I can expose you to the DOM and show you exactly what you have to look at, but being able to read it is put on you at that point.